Welcome, everybody, and thank you for taking the time to be here with us today for the Sygnia's latest webinar on the Sygnia Enhanced Bond Fund, which is an incredibly important fund for our investors. My name is Stephen Empodocles, and I am Head of Indexation here at Sygnia. If you have joined our previous webinars on the 7 superhero funds to help you ride out the volatility brought on by the coronavirus, you would have heard us speaking about the investment strategy and investing in a core satellite investment approach. I also provided an introduction on the Sygnia Enhanced Bond Fund, which is part of our core satellite investment approach that provides a source of diversified returns in a corona-led recession. So let's start off the webinar going back to basics. What are bonds? Why is it an important asset class? And how do they work? What are bonds and their advantages? A bond is a debt instrument with a promise to pay back money with interest. Predetermined interest payments will be made and principal will be paid back at the maturity. You do have certainty on cash flows unless the issuer defaults. Bonds are less risky investment than equities, and you will not lose your investment if the bond is held until maturity or if the issuer defaults. Bonds are less volatile than equities, and periodic income received through interest payments can be matched up with personal liabilities to remove asset liability mismatches. It is very likely that you're already invested in government and corporate bonds, which is one of the 4 main asset classes which are listed: shares, properties, bonds, and cash. Most retirement funds and endowment policies will have allocations to bond, as well as the majority of balance unit trust. Bonds are conservative, structured investments that provide stability to a portfolio. So what is a bond? A bond is a debt-based instrument that is created for the purpose of raising capital. Bonds are used by companies, municipalities, states, and governments to finance projects and operations. An individual bond is essentially one piece of a massive loan, can be thought of as an IOU with interest. In return for the capital provided, the issuer makes predetermined interest payments to the bondholder and is called a coupon. There are various kinds of bonds and can be set up in different ways with different structures. The main kind of bond issuers, starting at the lowest risk, are government, municipal, and corporate bonds. Payment rates made by the borrower to the bondholder can either be variable or fixed. Variable interest rates are usually linked to inflation or agreed upon rate called the reference rate. A very well-known and frequently used rate is called the JIBAR rate and provides extra protection against economic uncertainty and to protect investment goals. One major goal might be to protect your purchasing power against inflation after retirement. Bond instruments are issued for a predetermined amount of time, after which the loan funds must be paid back. When companies or other entities need to raise money to finance new projects, maintain ongoing operations, or refinance existing debt, they may issue bonds directly to investors. When bonds get issued, terms get set out, including elements such as the breakdown of the repayment schedule and the time at which the borrowed funds must be paid back, the maturity date. The interest payments is part of the return the bondholder earns for providing capital to the issuer. Usually bonds can be sold by the initial bondholder to other investors after they have been issued. In other words, a bond investor do not need to hold the bond all the way to its maturity date. It is also possible for the bond to be repurchased by the issuer if the interest rate declines or if the borrower's credit rating increase. And then they will simply reissue a new bond at a low cost. Fixed coupon bonds are usually issued at par, which means that the amount you pay at the inception is the same amount that you will receive at the end of the bond's life. The interest is paid throughout the life of the bond. If you buy a new bond and plan to keep it until maturity, changing prices, market interest rates, and yield typically do not affect you. but investors do not have to buy bonds directly from the issuer and hold them until maturity. Instead, bonds can be bought from and sold to other investors, which is called the secondary market. Similar to stocks, bond prices can be higher or lower than that of the face value because of current economic environment and the financial health of the issuer. Price is important when you intend to trade your bond. The bond price is what investors are willing to pay for an existing bond. There is an inverse relationship between the current price of a bond and the market interest rates, which means if market interest rates goes up, the price of your bond will go down and vice versa. To calculate the current price of a bond, all future payments must be discounted to the net present value. So as we can see in the graph, using a lower interest rate to discount each coupon payment will effectively lead to the bond being valued at a higher price than par, and vice versa. Ignoring the numbers, let's say you purchase a bond with a 10% coupon payment, and the market interest rates increase to 12%. If someone else were to purchase a newly issued bond at the current interest rate, they would pay less for the same future cash flow, or paying the same amount for a higher coupon, making a bond less valuable. Therefore, your bond must now be sold at a lower price to make up for the lowest interest rate the initial bond is, is earning. If the market interest rates were to decrease to 8%, your bond would now still be making a 10% coupon payment, which is now higher than the market interest rates, making your bond more attractive, allowing you to sell the bond for more than you initially paid for it. Just once again, these factors would not affect you if you held the bond until maturity. The return you receive will still be the interest rate at which you bought the bond at. Something you need to ask yourself before making any type of investment is what are the risks? Some risks of investing in bonds are the credit or default risk, which is a risk that the interest payment and principal payments due on the obligation will not be made as required. Reinvestment risk is a risk that coupon payments will be reinvested at a lower yield due to the change in interest rates. Interest rate risk is the risk that interest rates will change significantly from what the investor expects and need to sell before maturity. If interest rates significantly decline, the investor faces the possibility that the issuer will recall the bond. This means that the bond is repurchased by the issuer because the issuer can now rather reissue new bonds at a lower interest rate. If interest rates were to increase, then the investor will be holding an instrument yielding below market rates. Since the start of the year, South Africa went through a perfect storm due to the COVID-19 crisis. Our economy went into lockdown in the beginning of March, after which the final rating agency downgraded South Africa's credit rating to junk status, one day after the lockdown started. Now all the rating agencies downgraded South Africa's debt to junk because of the slowdown in economic growth and rising debt burden. The final downgrade led to the country's debt being ejected from international bond indices, and this happened at the end of April. The final downgrade led to the mass international sell-off, and foreign ownership is the lowest it's been since 2012. South Africa entered the Whitby Index in October of 2012, and in March of 2018, foreign ownership peaked, accounting for more than 40% of South African debt. International investors were attracted to high-yielding assets that investment grade of emerging markets could offer. Before the lockdown, Moody's was the sole major rating agency that have not downgraded South Africa's debt to junk. The final downgrade by Moody's was not unexpected and came after they downgraded their outlook to South African credit to negative in November of 2019, warning about South Africa's growing debt to GDP ratio. where the sell-off started in anticipation of the downgrade and where the lockdown caused uncertainty globally and investors trying to protect themselves from unknown risk. The rival rating agency Fitch and S&P both downgraded South Africa in 2017 due to the lack of growth, rising debt to GDP, and the financial cost of political uncertainty. The makeup of the return of a government bond can be broken down into elements and can be viewed as a build-up model. These elements can be seen as an investment into a 10-year government bond of a less risky country, and in this case, the 10-year bond from the United States. Adding an element of inflation risk premium, an exchange rate risk premium between the rand and the dollar, and the final part is the default risk premium, and in this case, the risk that the government will be unable to fulfill its duty to repay the debt to investors. Adding all these elements together shows the makeup of the return of South Africa's 10-year government bond. On the graph, you can see the breakdown of the elements and displayed over time. The default risk premium on the government bond has drastically increased over the period, showing the weak economic outlook, persistent physical concerns, and no confidence in the government to turn this around. Luckily, the majority of South African debt is denominated in rands and has protected the ability of the government to repay its debt in times when the rand depreciated in value. Unfortunately, the debt burden has increased with a debt to GDP ratio of 62%, where the government will need to make a structural change to turn this around. Fortunately, the government should not default on its debt in the long term, since they would be able to implement structural changes such as changing in the tax rate or simply printing more money. If South Africa gets to that level of default, there will be greater systematic risk investing locally to worry about. The R2030 is a fixed rate government bond and can be seen as a proxy for the 10-year government bond yield. It is currently providing a yield of 9%. And if you take into account inflation of 3%, then investing in longer dated government bonds can provide a real return of more than 6%. This is a great return on investment, and at these levels, active equity managers struggle to produce, especially in a low return environment. At these levels of real returns, South Africa is ranked #1 for the real return provided by the 10-year government bond, followed by Brazil and Indonesia. Once again, showing the value that can be unlocked by simply buying longer dated bonds. Local investors have seen the value potential and has become the biggest investors in South African government bonds. Inflation has come down from 4.3% in August last year to 3.1%, where the biggest drop has been housing and utilities, but remains one of the main sources of inflation. The other contributors are food and non-alcoholic beverages and miscellaneous goods and services, which includes personal care, insurance, and financial services. Now, let's get back to the main section of the webinar, how to invest in a bond portfolio and your options available with Sygnia. One of the most important funds that we have is the Sygnia Enhanced Bond Fund. The Enhanced Bond Fund is an actively managed fund with the objective of outperforming the All Bond Index Fund, index. The fund is actively managed only by including additional credit bonds, while not taking an active view on interest rate movements. Making a call on interest rate movements is a very difficult thing to do, and a lot of active managers fail at the task. By not taking an interest rate bet allows the fund to have a similar risk and return profile to that of the benchmark, but have a return enhancement by not only investing into government-issued bonds. Taking this into account and speaking towards harnessing yield and volatility in your portfolio leaves the fund perfectly positioned in providing additional returns with an interest yield of 10.5%. If you're uncomfortable with the extra credit, we also have the Sygnia All Bond Index Fund, which purely tracks the All Bond Index and provides an interest yield of 9.7%. A year ago, this graph looked much different. This graph compares the change in the yield from a year ago and shows that investors' mindset needs to shift. The return received from money market and income funds used to provide 8 to 10% when the repo rate stood at 6.5%. Providing a yield pickup of more than 1% above inflation, and income funds produce attractive returns above money market. Income funds was a great alternative in a muted equity return environment. Since the beginning of the year, South Africa went through 5 rate cuts, taking the repo rate from 6.5% to 3.5%, leaving short duration or variable term investments with very low returns, resulting in a drop in yield of money market and income funds to 4 and 6.5% respectively. Historically, the pickup in returns between investing in bonds over a money market investment might not have warranted the extra risk, but is not the case in the current economic climate, with the yield curve being as steep. The Monetary Policy Commission decided not to cut the repo rate in September, although it was a very close vote, leaving the rate unchanged at 3.5%. The South African Reserve Bank also stated that it would rather continue to monitor the impact of the support already provided, but also indicated that they see more room to provide additional support if need be. And this will just result in a further steepening of the curve. Keep your eyes peeled for the next meeting, which will take place on the 19th of November. So how's the fund performed? The fund is in the CISA category, interest-bearing variable term, and over the first full years of performance, the Enhanced Bond Fund A class ranked 8 out of 32 funds in its CISA category. The class slightly outperformed the index on a net of fee basis, while keeping true to its investment objective of not taking an active interest rate bet, showing the similar risk and return profile to that of the benchmark, while being able to have a return enhancement by including other investments. We are incredibly proud of the new fund. In the previous slides, we saw the value that can be captured by investing in South African government bonds, but the additional value can be unlocked by purchasing fixed rate credit bonds. The underlying investment of the Sygnia Enhanced Bond Fund are selected based on the yield offering of South African corporate, banks, government, and state-owned enterprises. The composition of the ORBI is still the main driver of the decision-making of allocating to credit. The fund achieved its outperformance by having increased exposure to majority government-guaranteed SOEs, banks, financials, and telecommunications, totaling 53%. This is compared to an exposure of 7% to SOEs in the ORBI. In this graph, you can see the credit spreads of South African bond issuers and how they compare to their companion government bond. Hardest hit during the period was non-government guaranteed SOEs, where the risk of default became increasingly prevalent, such as the likes of Land Bank, which defaulted on the repayment schedule. One of the good performing assets over the period has been government guaranteed SOEs, with the spread contracted compared to the government bond in the search for additional yield. Another notable change is the spreads are those of the senior bank paper, significantly contracting since the rate cut started, where the longer dated bonds is trading at yields lower than that of the government bonds with a similar maturity. We are very passionate about low fees here at Sygnia and should be a big driver when choosing an investment. Low fees are one of the most critical components to your long-term investment success, and we have shown in previous presentations the detrimental impact of high fees can have to your final balance at retirement. We are able to provide the fund at such low cost by passive index investing and not employing a large team of researchers, which would increase the cost significantly of managing the fund. As we have indicated in our previous webinars, the only variable that an investor can control is the management fee you pay. Both the Sygnia All Bond Fund and the Sygnia Enhanced Bond Fund both has annual management fees of 35 basis points excluding that. These two bond funds being one of the cheapest investments in its CISA category based on TERS. Speaking to our passion about low fees, also showing active managers are more expensive and the majority still underperforms or struggle to outperform on a consistent basis. And in summary, until business confidence does return, returns in equities will be muted, thus making the Sygnia Enhanced Bond Fund perfectly positioned for an investment opportunity and being a valuable part of a core satellite approach. With all the rate cuts and the steepening of the yield curve, yield can be replaced by switching cash into bonds by placing your capital at risk. Sygnia Enhanced Bond Fund provides a low-cost option to harness the yield in a low-return environment. Please stay tuned for our next webinar in about a week, where Anrich de Jager will be updating us on the Sygnia Global Property ETF, another valuable building block when constructing your portfolio. If you have any questions, please reach out to your business development contact. And thank you for joining.